Knocking down what doesn't belong creates a platform to build what does. So onward we must go, not falling into the trap of pointing at externalities, blaming the world for our confinement, but instead understanding that we have been, perhaps without even realizing it, taking our confinement with us, in our pockets, on our back, trailing behind our every step, a subtle resistance. And when it goes, we can finally grow. We can become more. So what can you do now to live a life that's more meaningful, that's more true to yourself? Well, you can start by doing less of what weighs you down.
The evolution of insanity. You have an idea, and you believe in this idea, and you start giving up what you have so that you can bring it to life. You start working on it to the point where you uproot and you leave who you were behind, and people say, that's odd, that's weird. And you work long days and you work long nights, and people say, that's not normal. You give up everything, hour after hour after hour. You become one-dimensional. You become solely focused on this one thing that's not validating now, that's not providing you comfort now, that's scary now, and people say it's insane. It's not normal. It's out there. It's beyond the realm of what's acceptable in modern day life. But then you succeed. And you succeed at this thing like no one has done before you. You have changed the world in some capacity. Now those very same people, the ones that said you weren't normal, said it was crazy, the ones that said you were insane, they want to know how you do it. How can they make that change in their lives? Those very same people want the tools that you use to build this new reality. And eventually, they look at you as someone at the top of the mountain who has all these things, who succeeded to such an extent that they start calling you lucky. And you look back at those people, those very same people, and you think, lucky? I gave everything for this. I went through hell for this. To say I'm lucky, you must be insane. That, my friends, is the evolution of insanity.
Montesquieu once wrote that we receive 3 educations. One from our parents, one from our schoolmasters, and one from the world. The third contradicts all that the first 2 teach us. That thing called life, right? And the more I think about this, the more I get it. The most important rules are the unwritten rules. The most significant boundaries are the ones we learn to ignore. The greatest tests don't concern what we know, but our ability to move forward when we don't. It's the real world that shows us we only get meaning through sacrifice and discomfort. That shows us the homes we lived in and the classrooms we learned in were meant to block out the uncertainty and unpredictability of life. They were meant to draw a line directly from effort to result and cause to effect, but the line that the real world draws, well, it isn't so straight. At least not all the time. And it's this third education that shows us how powerful we truly are. Sometimes I think back to the beginning of my entrepreneurial journey, that first year, the writing, the recording, the producing, the editing. The beginnings of a pursuit that I believed to be so important. looking around and just seeing no result, like none, and thinking, how could this be? You know, I worked so hard, suffered so much, I put all of me into this, only to realize I had no clue what all of me meant. And that what I thought constituted life was really just the tip of an iceberg that extended so far underwater that it would take a lifetime to uncover. The real world, upon introduction, always starts by showing you how much you don't know. And I look back and I don't really think about the financial concerns, although they were very real. I don't remember much of the everyday worry and anxiety bouncing around in my head, although it was definitely there. I remember learning one of the greatest lessons I've ever learned, that life is hard, but it's supposed to be. And it's not standing in front of you, hands on hips, saying you can't have this. It's extending its hand out, saying, my friend, if you want this, it's yours. But understand what that means. Understand that you'll spend a good portion of your time unsure about your path. That you'll exhaust energy that will, a lot of the time, go unappreciated. That the easy road is fine, but it caps you way before your best. And if you want to take this on, this road before you, you have to pay a higher price. They can have predictability and peace of mind and comfort, but this path, it takes you to purpose and meaning and an evolved self. And you may think you understand what it means to be proud now, but wait until you touch these things. Wait until you look at your reflection, knowing that the person staring back at you could have said no time and time again, but didn't. Just wait, my friend, until you feel what that is like. Your parents and grandparents can't tell you, no book can explain it for you. It's the curriculum of life. The real world education, where the tuition is temporary discomfort and graduation isn't one, but a million little evolutions. It is the stage that's calling your name, the one you're ready for, whether you know it or not. What is the complex but an accumulation of that which is simple? What are big things, if not just a multitude of little things? There's comfort in the understanding that all we have in life, all there is simplicity, easy to understand pieces. It's just that sometimes we stack them so high that they start to take a new shape. But like Greg McCune references in his book Essentialism, the power isn't always in acquiring answers. You already have them. They're in front of you. The power is in cutting away the things that don't need to be there. Removing all that stands between you and your ideal existence. And I think that's one of life's great misunderstandings. We don't need to find more. We need to remove that excess until we're face to face with what matters. And to adopt this principle, it's nothing short of liberating. Chaos, confusion, disorder, they don't imply that you lack the right things. They suggest you haven't stripped life of the wrong things. You have not simplified. 1,000 miles is intimidating when you look at it holistically. It's a long journey. But it's just a collection of steps, and well, shouldn't we find solace in the fact that anyone can take one step? It's not a game of complexity, it's a game of understanding what's in front of you. And what's in front of you is always manageable. So much of our stress stems from forgetting what that journey is made of. Whether it's a change in career, mastery of an art, some kind of personal transformation, the result we want. When looking at it from the starting line, it's too complex to understand, too many pieces stacked up. So let's break it down. Let's find the foundation. What's really there? What are the 1, 2, 3 things we need to do? What is that golden question? What matters? If you lose sight of that, then you will stumble through life. I've learned this. I've lived it. The time I take to myself every day is invaluable to me because I ask myself those 2 questions. What matters? And what are the simple steps I need to take? Right? What can I remove? I was talking about this during an interview this week. My personal growth. And one of the most important aspects has been the understanding and the zeroing in on what's important. I used to take so much pride in composing the background music to these speeches, end to end. Right? I used to love to be able to say I did it all. That was, so I thought, the great differentiator. But ultimately, I learned to take a step back and ask what matters here. What do you care about? It's the storytelling that I love. It's the impact. And let's be real, no one cares who wrote the background music. It's holistically, how does the piece make you feel? Right? And this understanding allowed me to cut away. License the music, save 2 days a week, acquire clarity, and realize my goal is not to be Mozart. My journey is to be one of the great communicators, storytellers of our time, and if a day goes by where I'm not taking a little step towards that, it's the wrong move. Small example in the grand scheme of things, but right on point. It's the power in understanding what matters that makes a difference, that allows you to grow, evolve. And I'm confident that this not only applies to long-term pursuits, but also our challenging times, the dark moments, the periods of uncertainty and discontent. Same concept. Where do you want to be, and how do you get there? What's the simple thing you can do to close that gap? Because you are never helpless. You can always do something. And my friends, those little somethings ultimately evolve into everything. And when we put our phone away, step beyond the noise, spend time with ourselves, we can see how much of life is running in place. Stacking and stacking pieces that aren't even part of the masterpiece we're trying to assemble. If you want answers, start with the understanding that they're buried under mountains of things you don't need. So cut away. Cut away the people and places and things that convolute your story. Cut away the exhaustion of time that provides no value in return. Cut away the thoughts that make life more complex than your journey from where you are to where you'd like to be. As you stand right now, you have everything you need, and there's nothing greater than that, nothing more powerful than that understanding. So why not step outside the complexity that you've manufactured, that you're living in, into a world of clarity, simplicity, and capture what matters.
Good morning, everyone, and welcome. I'm super excited. Can you believe we're on day 3 already? And I was thinking about it this morning. I was at gym and I was thinking to myself, I was talking to someone yesterday that's doing an MBA, and I thought to myself, most people that are doing an MBA, and I would challenge people on this. I doubt that they're going to get as much information and as much practical knowledge from partners as what you're getting. And why I say that, you haven't even seen what's coming. Like the caliber of speakers today, the caliber of speakers tomorrow, like it's just going to get better and better. So I'd like to, again, welcome you to day 3. I hope you're enjoying it as much as I am. We are getting some great feedback, so really appreciate it. Thank you to everyone that said good morning. Always wonderful to have you online. I want to get straight into it because we've got an amazing guest joining us this morning, and or wherever you are in the world, whatever time zone you are. And I want to make sure that we can start on time with him. So let's go straight into it. What is day 3 all about? It's about building a diversified portfolio. It's about asset allocation. And these are words we've probably heard of before, but most people don't even really know what that's all about. Learn how to craft a diversified investment portfolio that aligns with your financial goals. Wouldn't that be cool? Imagine if you had a diversified investment portfolio that aligned with your financial goals. That's what we're all about today. Just to remind you, I'm not going to go into this in a huge amount of detail, but pay lots of attention, take notes, literally try to teach other people, use the Facebook group, put stuff in the Facebook group, share, ask questions. You know, it's all about community. Play full on, do the exercises, commit to action for 5 days. You know, make sure you're setting yourself goals, have fun, and take action. Now, reminding you of the resource guide. So, you know, one of the things that we want you to do, we're trying to offer insane value. Obviously, for the VIPs, we want to take it to a whole nother level. But you've got this resource guide. So go there, use it, and every day we update. And if there's links and stuff to share, we put them in there. And, you know, I hope really that you're using that. The WhatsApp group, you know, make sure you're on the WhatsApp group. That's how we communicate. That's how we share. If I think or Shane thinks of something important, we put it up there just so that you know. We have made it one directional, so it doesn't get noisy and busy, and we can just keep you updated. The Facebook group, on the other hand, is a community. Go and use it, go and chat, go and talk to people, go and ask questions, engage. We're here to engage with each other and to learn. The only thing that I ask is that no one tries to sell people stuff. It's not a classified, it's a learning environment. And then we have a prize winner. And I'm super excited to announce our VIP prize winner from yesterday. And Fusi Musa Intuli is our prize winner for today. And, you know, for me, it's a story that reminds me of what my father taught me. Where there's a will, there's a way. Where there's a will, there's a way. You know, literally contacting me over the weekend, wanted to join the VIP, tried to pay online. There was something wrong, went in the bank, sorted it out, you know, literally, and then took advantage of the offer to, put it out on the social pages. And, you know, yesterday and has won the prize. So, you know, it's a great example in life. No matter what adversity you have, where there's a will, there's a way. And so, Musa, it's fantastic to welcome you to the VIP. And for those of you, if you haven't signed up yet, there is still time. I'm hoping that Anthony is going to be joining us live in the VIP room today. As long as we don't go too long, he has committed to doing that. And so it's going to be really awesome. And every day, you know, we've got these guys to come and talk, myself, to literally offer as much value as we possibly can. So there's always an advantage, you know, to being on the top of the mountain. To remind you again why we're here, it's about globally diversified passive income. Just in case you've forgotten, globally diversified passive income. How do we do it? Well, it's about diversifying across countries, currencies, assets, partners, and time. And, you know, any goal in life, you get clear on what your long-term goal is. You then set sub-goals, and then you have tasks and activities. So let's go to your tasks and activities that we set you for last night. It was to go to your sheet. Here's my sheet. And to fill in your top 5 countries, to fill in your top 5 currencies, and to fill in your top 15 assets. It was also to watch Ann Wilson, the amazing Welsh chef, Ann Wilson. And I'd love to know, put it in the chat box. What did you think of Ann Wilson? What were some of your takeaways? Incredible lady. You know, one of the things I love most about her is her energy, but even more so the way she simplifies this complex world of investment and makes it easy. And if anyone's wanting to invest in the stock market, I don't know a better person on the planet in terms of helping people to be able to do that. And then, did you share a key takeaway on social media under diversification? One of the greatest principles in life is that if you want to learn something, the greatest way to learn it is to teach someone else. I'm probably going to get more value out of the next, 5 days than anyone else. And that's no disrespect, but it's because I'm teaching you. So it's reinforcing in my own brain. And so by going out and sharing it on social media and sharing it with your friends, you are reinforcing the key lessons that you learn. So not only are you adding value to their life, but you're adding value to your life. And, it reminds me of a saying that I've tried to build all our businesses upon from Zig Ziglar. You can have anything you want in life if you help enough other people get what they want. You can have anything you want in life if you help enough other people get what they want. The gold bonus was, with time to go back and to do your risk tolerance. And there's lots on the internet. You can go and do another one if you want, but I found one from Missouri University that I liked. Just to remind you again, today's not about financial advice. Neither us nor our partners will be providing financial advice. It's a public forum, but what we will be doing is sharing our expertise, sharing our knowledge, sharing our opinions, sharing our experience, sharing our mistakes, and then also learning from, what the best in the world are doing in terms of the big picture and the process. And so just to remind you, if I go back here, and I just want to grab the slide because I know that it's, resonated with a lot of you. Just to remind you, let me stop my share quickly. Hopefully by day 3, we've got no more dabblers. The dabblers are gone. They're off to play paddle or to read a book or to, try to become a day trader or something. Like they've literally given up. Okay. The stressors, well, they're probably still going, oh my word, like look at the resources page. There's so much information, analysis paralysis, information overload. Oh my word, stress. How the hell am I ever going to do all of this? They're probably still here because they like to stress and find the way, but they're probably panicking. And then you got the master, and the master is sort of sitting back, man or woman, doesn't matter. And they're focusing on mastery, and they're saying, right, like I know where, I know roughly what I want in life. I might not know exactly what I want. We can talk about that today with outcomes, but I know that where I am right now is not where I want to be. So I want to get something like globally diversified passive income. There's a whole bunch of steps along the way, milestones that I'm going to do. And the easiest way to get there is through partnership. And what we're going to learn today is literally my philosophy. And I learned this from Tony Robbins. If you want to get wealthy, copy wealthy people. If you want to get successful in basketball, copy a successful basketball person. If you want to get successful in knitting, copy a successful knitting person. So if it's about wealth, why would we not go out and copy the wealthiest people in the world? And the next 2 speakers that we got, I'm so excited to share with you because literally that's what they do. They literally help the wealthiest people in the world. And so if they can share what the wealthiest people are doing, surely we should be copying them. Like hopefully that makes like a lot of sense. That's mastery. Okay, it's called modeling and mastery. And then one better than that is partnership. And I'm going to share with you today how you can partner with the people I'm going to be sharing with you today. Whether it's Fiona or Anthony and the team, I'm going to share with you how you can partner with them. So let me share my screen quickly and let's get going into day 3. Reminding you again, golden formula, we've already been through it, but this is it. Repetition is the mother of skill, so I'm going to keep bringing it up. We're now going to go into asset allocation and portfolio construction. So there's another friend of mine, a guy called Mark. He runs a company called International Academy of Wealth. And I learned this from him a couple of years ago, and I really loved it in terms of the wealth pyramid. And Wilson last night, funny enough, on the video, if you've done your homework, also spoke about a pyramid. And the pyramid is the strongest structure in the world. We all know that it was sort of invented by the Egyptians. And whether it's a pyramid just like this or the way a real pyramid is, it's the strongest structure in the world. And what I love about it, when I just wanted to bring this up, I'm not going to sit here and try to sound like an expert, because Mark does a far better job at this than I do. But ideally what you want is you want different types of assets that have different types of risk, different types of returns, and ultimately different timeframes. And you'll see here what he's got is he's got foundational assets, wholesale assets, focused assets, active trading, wholesale cash flow, and ESI, which is much more speculative in terms of investing. And you'll see on the left-hand side here, the potential returns, down the bottom are conservative. They lower risk, and they've got conservative, applications. As an example, if you invest in crypto, you might make great returns. You might also lose everything. If you go to the casino, you might make great returns. You also might lose everything. So it's, you've got a different spectrum. On the one side, you've got things like property, where it's much more stable, there's a lot less risk, very much more stable returns. That's why they're called foundational assets. And at the top, you've got things like crypto, as an example, in terms of, where you might get or venture capital, where you might invest in, the next Uber, and it might completely take off and you might make a huge amount of money, but you also might invest in something no one ever hears of and you lose everything. So what's on the right-hand side here is that when you own foundational assets, you want to hold them forever. If you've got a good quality building, you never want to get rid of that. Wholesale assets, 1 to 3 years, focused assets, 2 to 10 years, active trading, obviously that's buying and selling stuff, wholesale cash flow, and then ESI. And we're going to talk more about that if we want to in the VIP room. I really don't want to get into confusing people. But what I do want to do now, because I want to be ready for Anthony once he joins, is I want to go to a 5-minute video. This lady, literally, Fiona. So Fiona worked for Knight Frank. Knight Frank is one of the biggest estate agencies in the world. They specialize in the high net worth sector. And every year they bring out the Knight Frank Wealth Report. It's the most conclusive report. Some would argue otherwise, but according to many, many people, it's the most conclusive report in terms of what are wealthy people doing around the world. So they go out and they interview over 500,000 of the wealthiest people in the world. Now, she's Australian by background. She's joined Knight Frank in Hong Kong. She then worked in the London head office for 8 years, and she actually ran the entire team, 80 people that ran the wealth report. And she's now back in Australia, and she's actually, we've got opportunities with her and her partner in Australia. But what I loved about it, and she did this for our mastermind in, I don't know, I think it was June, July this year. She came and she took the last wealth report and she said, what is happening in the wealth report? What are the wealthiest people doing? How are they allocating their assets? So let's see what she's got. Her father, unfortunately, passed away in the last 2 weeks. And so she couldn't join us live, but we made this recording with her.
The high net worth and set the scene on what was happening in 2022. 579,000 ultra high net worth individuals in the world in 2022. So people with assets of 30 million plus. That is a 44% growth in ultra high net worths in the 5-year span. Remembering this report, as I said earlier, has been in existence for 16 years. So there's quite a bit of background data that we can draw on it to pull these statistics. 16% of those is the regional growth in the Middle East of ultra high net worth individuals. The fastest of that Middle Eastern market is actually the UAE, which had an 18.1% increase in the last 12 months of ultra high net worth individuals. The high net worth trend is actually, so back down to the million plus asset, increased 2.9 in the last 12 months, and there's actually 70 million of those worldwide. The top 3 fastest growing wealth hubs were actually in Asia, and they were Malaysia, Singapore, and Indonesia. And the report's saying that 59% increase in high net worth in the next 5 years, which will take that up to the 100 million mark, and 744 ultra high net worth, so 28% increase in the next 5 years of people with assets in 30 million plus. The one just above that ticked over in the last 12 months is the billionaires. It actually declined in the last 12 months, 5%, and it's down to 2,629. Okay, so that just sets a little bit of a picture of what's going on from the wealth perspective. A breakdown of the populations, and this is a little bit what I was talking about. There's actually a 3.8% decrease in the ultra high net worth population. However, in 2022, there was a 9.3% increase in 2021. So it's just averaging out slightly. So it's not that concerning. The wealth fell by average of 10% across the performance in the markets, and that was really due to the equities and bonds, which had their worst performance in years, actually since the 30s. So property obviously rated and stayed quite stable, but it was the other factors in the portfolios that had that decrease. However, of the advisors, they're saying 69% of the advisors say that their investors are will see an increase in growth in their portfolios in 2023 as things start to average out. The other thing that's worth noting in all of this, as I'm talking about these numbers, as I said, the wealth report launches in March of each year. We're obviously now in June, and the data is actually collected in November of the year before. So we're in a market at the moment where things are moving pretty quickly and numbers are correcting and changing as we speak. So you'll notice that there will be a few little things in here. And if I have the most relevant and updated information, I'll let you know those numbers, which will be different to the wealth report. Okay, so of those 579,000 people, let's have a little sneak peek at what their little portfolio makeup actually is. So primary and secondary homes is 32% of their portfolios. And I think that you can read through the rest of those there. I hope that's quite clear for everyone on the screen there of the breakup of their portfolios.
That's fascinating. I've never seen that before.
Yeah. Well, see, that's why it's very good for, when you're collecting this data is actually to go to the advisors because they have all of this information at their fingertips. So they know what they're investing their clients, what they're advising them to do, what they're coming in and out of right at their fingertips. So it's actually really interesting data. And to dig in a little bit more, I haven't here, but actually in the back of the wealth report is the data bank. And it breaks all of this down in further detail. So if you're super interested in understanding this, just go onto the site and download the wealth report and you can see the data bank.
So Scott, do you propose some of these things generally within your?
Yeah, well, I think like for me, if I'm looking at alternative investments, you've got commercial property, you've got private equity. We're not doing it through funds. So it's just interesting looking through it. I mean, next month we're doing gold. So it's just interesting looking at I'm quite surprised equities is only at 26%, to be honest, generally in terms of portfolio. And one of the things that I've been reading about is that the ultra high net worths are pushing up to 50% plus in alternative investment. Now, primary homes and secondary homes would fit into that alternative space. So it's pretty, look at that, 32 plus 21. Between residential and commercial, it's over 50% on its own. Yeah,
but also remember, as I said in the earlier, this is a very select clientele that we've gone to around the world. The other thing too is you'll see, I think I have it in here, the amount of properties that are owned per client. I think it's something like 3.8 houses on average, whereas in the Middle East it's nearly 6. So it's not surprising that the residential side is pretty high.
No, look, I hear you completely, Fiona, but I think also what I'm trying to share with my fellow masterminders is, that philosophy I keep saying over and over again. If you want to get wealthy, copy what wealthy people are doing in many ways. And so, yes, this is the select crew. I get that, but it's 500,000 plus people around the world and that has literally access to the best advice in the world. And this is what they're doing, So, yeah, that's my take. I'm not saying it's right or wrong.
Yeah, maybe just to you're perfectly right. Maybe just to set that scene. Knight Frank actually sell homes to the ultimate homes around the world. So I think that without telling any tales out of school, pretty much the super high net worths are the ones where all this information is actually coming from.
Yep, perfect. Awesome. Well, there you have it, ladies and gentlemen. That is what, according to the latest Knight Frank report, that is what the breakdown is. So what I'll do is I will. Sorry, what's going on? Start my video. You can basically see the full breakdown. But what I want to do now is I want to pivot. And I'm very, very excited. I can see Anthony's joined us, which is fantastic. I don't have my camera on. There we are. It's on now. And what I basically wanted to do was there was a quick little video that we did, again, with our masterminders back at the beginning of this year. And Garth Wellman, who's the co-founder and CEO of the business, and Anthony, his partner, were effectively explaining to our masterminders about asset classes and asset allocation. And I want to play this video. It's literally 30 seconds, and then we're going to pivot over to Anthony live in terms of understanding and explaining.
This doesn't change, guys. Asset allocation, and this is not all of the asset classes we work with, but asset allocation is going to account for 85% of your return and is the fundamental building blocks of asset management and a financial plan that's going to, produce income or anything. But Anthony's going to talk to this, and this will give you very specific kind of views around the returns, the averages, and where we think the value lies.
So,
this doesn't change, guys.
Just if you take that, what was said there, 85% of your long-term returns come down to portfolio construction. And it was actually one of my partners, Alex, whose idea it was. Him and Anthony worked closely together. And he said, Anthony, that's a lovely little quote. 85% of your long-term returns come down to portfolio construction. But what does it actually mean? And so without further ado, I wanted to hand over to Anthony. I'm going to stop sharing because I've got the presentation here, Anthony, if you want, but I think it'd be easier if you drive from your side. Have you got it with you?
I do have it with me. Thanks, Scott. I'll happily share it on my side.
So just to introduce you quickly, Anthony works with Calio. They manage 60 families. They've got about $600 million under management. And the reason I love working with Anthony and the team is that if you're helping 60 of the wealthiest families in the world, you're getting access to the best information, the best advice, and ultimately, you're passing that on to those 60 families. And what I love as part of our mastermind is you then share that with the rest of us participants and help. And, it reminds me of a little story. Derek, who's a farmer, and he's been sort of with us for the best part of about a year. And Anthony and him met last Friday or 2 Fridays ago. And he phoned me, Anthony, and I think I've told you this. He literally phoned me up and said, that was phenomenal. Those were his exact words. I'm not exaggerating. And the reason being, he said, I've been looking for years, he went on to say, like decades, to find someone who could actually help me with investment advice. Again, is registered legal to be able to do that. And just help me look at everything and be able to make the right decisions. And, that's from someone that I've worked with for a year, and he couldn't have raved more about you. So without further ado, I want to hand over to you. You're going to share with us literally what is portfolio construction, how do people do it, what do you advise the wealthiest people to do, and how can we copy?
Excellent. Thank you, Scott, and thank you, Derek. I agree. It was a very powerful meeting in the limited time that we had available. It was very good. All right. So as Scott, as you mentioned today, we're going to dive into portfolio construction and just essentially the fundamentals of portfolio construction, which get 85% of your returns. We'll touch on asset allocation and things like that within the presentation, but ultimately we're going to aim to cover 6 main topics. The first being one's time horizon, the second being one's risk tolerance, the third being asset allocation, the fourth being diversification, the fifth being your personal outcomes or goals that you want to kind of associate or attach to the money that you're looking to invest, as well as the kind of closing one of monitoring, measuring, and rebalancing the changes that you've made to your portfolio. So the first topic, time horizon, probably one of the more important topics of the bunch. We typically find if this is thrown out, then you don't really have an accurate roadmap or something to use to guide you throughout the whole process. And really, it's all about understanding the current situation relative to where you want to be. How we do that is a thing called asset liability modeling. And essentially that looks at your assets minus any liabilities as your kind of current asset base. And then it looks to kind of plot and understand how you view those investments growing, as well as any potential liabilities that you'll need to withdraw from those assets in the future, right? And then it's about understanding that ALM, which I'm going to dive into a bit more detail now. And then it's about defining the parameters of those of that ALM, because obviously the parameters they can make a big impact on the ALM. Now, I always kind of say this to people when I'm working with them through something like this. This is not the silver bullet. It's not the holy grail. It's not to say that everything's going to go perfectly to plan. As we know, investments can be volatile. They can have good years, they can have bad years. But ultimately, if we start to get an idea of the roadmap and where we want to go, we typically find that we're in a far better situation than just kind of freestyling it as we go along and just trying to make things up as we go. So diving into the parameters of this ALM, I've just done a kind of brief example here, just using some very random numbers, but I think it will help get the point across. So what we look to understand is the age of the client or the age of the person. In this example, we've got Mr. X, who's age 45. The plan or the goal is to retire at age 65. That's quite a traditional retirement age here in South Africa. Again, ultimately, this number can change, can go down to 55, 50. It all depends on the scenario and the parameters that you throw at it. What we then do is we look to protect the portfolio for a number of years. In this case, we use 35 years, which essentially, if you take the 35 plus the 65 year, you're aiming to provide a scenario where you're protecting capital, or your capital is sustaining you up until age 100, which I think we can all agree, although modern medicine is presenting its kind of ability to make people live longer, but I think age 100 is a pretty fair number. If there's any excess, that we typically view that as the kind of legacy aspect of the portfolio, or an inheritance for kids and things like that. We've got our years of saving, which is an important number. That's at 20. That's the difference between your retirement age and your current age. So that's assuming that one is still working, they're still running a business, they're still employed, whatever it might be, and they're able to contribute to the portfolio, right? Current income, we said Mr. X earns R1 million a year. It's not overly important, that number. The more important number is how much of that is one saving or contributing to the portfolio, which I'll get to shortly. Then we make some assumptions, right? We assume inflation.
Just quickly, Anthony, one thing I just want to say is we've got people from all over the world that are joining us. So you're just using a particular country or a currency, but it doesn't matter. It's more the principles you're teaching.
100%, Scott. Switch that R for a dollar sign or a euro sign, whatever it might be. It's all relevant, because your expenses that I'll get to now will then be based on that amount. So it will all be relative. All right. So then we look at some of the assumptions. We assume inflation at 4% again. That's pretty geared to the South African market. You can alter that based on where you live and your inflation assumptions. We look at a return pre-retirement and a return post-retirement. We put a pre-retirement return on this capital of 10% and a post-retirement return of 8%. The reason why you see that taper off a bit into retirement is that typically when we build these portfolios, when we know that there's some time to go until retirement, we're able to be a little bit more aggressive on that capital and target higher returns that traditionally come with higher levels of volatility. And then we start to taper that off into a more risk-adverse portfolio on retirement. And the reason for that is when you make drawdowns from your portfolio, you don't want to get yourself into a scenario where you've got very risky underlying investments and you dependent on this capital, which would force you in a downward market to make withdrawals from a lower capital base. So we taper that off because the risk profile naturally tapers off as the client gets older. All right, moving to the right-hand side. We then look at our retirement income, which is also a very important number. So the retirement income assumes that Mr. X would like to kind of keep up with his current income, and when he retires, he would like to withdraw an annual amount of R1 million from this portfolio. So in other words, that's what he feels he needs to live off for the year, right? That's an annual income payment. Again, this is highly dependent on each person's current scenario or different scenario, but we've assumed that for now. We ignore the numbers in the gray shaded area, just moving down onto the savings habits. So this assumes that Mr. X is making 240,000 Rand contributions to the portfolio throughout his years of saving, right? Which again is the amount of time between his current age and his retirement age. So he's contributing around 20,000 Rand a month to the portfolio. And then the current savings balance is your current assets, your current capital, your current investments, less any liabilities. So we typically include all investments in there. We do include houses. It's obviously quite an important one. It's a difficult assumption because one needs to apply some kind of growth rate to the house. And this assumes if you take a house or fixed property or things like that into account here, you'll need to be quite confident that you can achieve a return of around 10% based off our pre-retirement assumption. But in a nutshell, that amount is your current investments or your current capital less any liabilities. Now, when we jump to the next slide, we just kind of break down and we see what this looks like over time, and we kind of start to understand the compounding effect on capital, as well as the effect of making contributions and what that looks like. So if you can see my cursor here, which I'm hoping you can, you'll see in the balance column, we start with our capital amount of 3 million, and that is growing each year by 10% based off our pre-retirement assumption, right? We've got a contribution column, and that is starting off from the 240,000, but importantly, that's growing by inflation of 4% each year. So it's making the assumption that you're going to be able to contribute slightly more each year leading up to retirement, right? Whether that's via investments or things like that, or whether that's via salary increases or taking more money out the company, whatever it might be, the assumption is that that number is growing by inflation. And the salary, which is not overly relevant now, but you'll see that kick in shortly within the withdrawal column. But again, just understanding what that compounding effect of inflation does to one's salary, right? So there's an assumption there that you're going to have to increase your withdrawals based on inflation, so that you can have the same purchasing power that you do now in 20 years time, when you become reliant on the withdrawals from the portfolio. So jumping a screen ahead, you can see we've been running the age column on the left hand side, but now we're essentially at age 65. Mr. X is retiring and he needs to start making withdrawals on this portfolio to sustain himself. Right, you can see the capital here has grown up to 39 million. It was untouched. We weren't withdrawing from it. We were achieving 10% a year and we were making contributions. So you can see that compound effect really taking place. But importantly, you can see the withdrawal now as we set it at 1 million. Mr. X only needed 1 million rand, but now it's at 2.1. And the reason for that, again, is to assume that these withdrawals need to increase by inflation each year so that your purchasing power remains the same. So you can start to see how the effects of that increase on the withdrawal, even though we've got a capital base that's grown quite nicely, you can see here around year 33, 34, 35, or age 77, 78, 79, you can start to see the capital value starts to peak and it starts to taper off because the growth is no longer outweighing the steep increase in withdrawals, which is naturally going to happen. It's not the end of the world, but it's just something to keep in the back of your mind, that there will become a lot of pressure on the portfolio based off inflation and the amounts of money that you need to sustain yourself each year. And then in this scenario, we're getting to age 92, and you can see here the capital starts to become depleted throughout kind of 91 and a half years of age, or 48, 47 years from when we did this at the beginning. So this is just really just to give you guys an understanding of how these things work. Like I said, it's not set in stone. Return numbers change, but ultimately this is guiding a lot of the decision making around the portfolio construction, this ALM, because we know roughly what we need to target with the different amounts of capital, right? We can't be sitting on 3 million. I'm just going to go to the thing. We can't be sitting on 3 million and targeting a 6% return initially on the capital, because then you're going to have a scenario where this capital runs out far quicker. So it just kind of sets the scene for what you need to be looking at, what asset classes you need to be looking at to deliver those kind of returns. All right, moving on to point 2. Here we look at the risk tolerance, and this is largely driven by one's time horizon. We view market cycles as typically 5 to 7 years. We start to get excited about equity market opportunities and things like that if the investor has a time horizon of around 7 years, because it means that we can sit out a market cycle and we can be unimpacted by the volatility or the up and down market movements in between that cycle. So they become largely irrelevant if your investment horizon is longer than that, because you understand that you're not at risk. You don't need to make any withdrawals in that period. And if you just look here at the bottom left on this chart, ultimately what you can see there is you can see it going from, the chart starts on the bottom left and it ends at the bottom right, but it goes up and down in between, right? And that's typically what we expect out of equity markets. We expect volatility, but our overall trend over that period typically trends upwards, and that's what we're looking to achieve in these portfolios. If an investor has a market or a time horizon of let's say 3 to 5 years or 2 to 3 years, something a lot shorter than that, you're typically going to be looking at other asset classes to try and achieve those goals, because you could find yourself at the bottom or at the trough of a market cycle, and then you could potentially be in a position where you're losing capital. So you don't want to plan around that, and you don't want to withdraw during times of stress. You want to at least have a market cycle fully play out. And the last point there is I say that personal goals play a large role in determining the levels of risks one can take. And really that's quite straightforward. If you're looking to buy a house or you're looking to buy a car in a year or two's time, you're not going to take all of that capital and put it into equity markets for the reasons I just highlighted above. You're going to look at something a lot more risk-free, a lot more stable, a lot less volatile, versus if you're saving for retirement and you've got 20, 25, 30 years to go. Then you can stomach that volatility. You can take on that additional risk to achieve that additional return, and you can see out those market cycles. And again, just on the bottom right, a fairly obvious chart that's sometimes overlooked. That's really just showing you that the higher the risk you take, typically the higher the return one can achieve. So one needs to be comfortable in their understanding around that. You're never going to get a scenario where you're taking no risk but making massive returns. And again, this obviously feeds back into the ALM, because the ALM has guided us as to what we need to achieve over the different time periods of one's life. So we know kind of what we're looking for and what we're going to build that portfolio around. Topic number 3 is the asset allocation. Again, this is largely driven by the parameters of the ALM. It's also dependent on the time horizon of the investor. And again, it can be influenced by one's personal goals. So in terms of the ALM, what I've done here is I've shown just a little screenshot or a little chart just to give you an idea of where returns are at and where relative to risk. And you can see here the first line item is a very vanilla MSCI World ETF. That's an exchange traded fund that tracks developed markets, so US and Europe. And that over the last 5 years, ending 31st of August this year, has achieved an annualized return in US dollars of 10.31%, right? At a risk or a standard deviation of just shy of 16. Now, that obviously makes no sense by itself, but when you start to look at it against the second line item, which is the global bond market, an average of the global bond market, and the last line item, which is US cash at the moment, you can get a sense of the returns, right? The returns in the bond market haven't been great. Traditionally, that probably sits closer to 2, 3, 4%. But what's more important here is to understand the significant drop-off in risk. So you're going from pure equity at around 16, you're going to bonds at around 6 odd, and you're going to cash at pretty much 0. So that just gives you an idea of where you need to kind of look for your returns. Obviously, there's alternatives, as I show on the right there, and there's private equity and things like that. But traditionally speaking, this gives you a good idea or understanding as to where the risk lies, and what kind of returns you're going to achieve, which again speaks to the asset liability modeling and how those portfolios are constructed around those specific parameters. Alrighty, moving on. Number 4, the fourth topic we look at is diversification. We look at diversifying holdings across different asset classes and sub-asset classes. Fairly straightforward. I've given a chart on this on the bottom left, but you can see at the top our 5 main asset classes being equities, bonds, alternatives, commodities, and cash equivalents. But we note that there's a lot of underlying sub-asset classes under each of those asset classes. So there's a lot of areas where one can kind of find value or find opportunity or find investments that are able to tick the specific boxes that they as an individual need, right? So you can see, I'm not going to go through all of them, but you can see kind of the broad brushstrokes of the sub-asset classes. So we typically look to diversify amongst a lot of those. Again, a lot of that's based off research and macroeconomics at the time, but we try and have quite a broad exposure there to aid in diversification. The second point is that there's an ability to add alpha via manager selection and style allocation, right? Alpha is outperformance. Alpha measures outperformance relative to a respective benchmark. So if you have an active manager that is using the S&P 500 as his benchmark, if he's able to outperform the S&P 500, that difference in outperformance is categorized as alpha. So what we're saying is that even though you might see indexes like the MSCI World in our previous chart achieve a return of 10.3% annualized over 5 years, with the help of an investment professional, you can start to identify fund managers who may have beaten that benchmark over time and generated alpha, which obviously aids in the asset liability modeling and generating returns that are higher than that of indexes and higher of that than what the individual needs to achieve to make his ALM parameters hold true. Which I'll show you an example of that on the next slide. The next point is using active managers to shift between different styles of investing. Again, there's a lot of highly skilled individuals out there who have done this for many years, who have the ability to navigate between those different sub-asset classes as and when the value starts to emerge in all of them, which is quite important. And again, I'll show you an example of that. A very interesting chart on the right. This is a chart that I love, that really talks to A, diversification, and B, the inclusion of private equity or alternatives in an investment portfolio. I said it last time, but don't look at this as private equity. I would kind of include all alternatives in this section here. So real estate, private equity, hedge funds, and infrastructure. But in a nutshell, what we've got here on the bottom axis is our standard deviation or our risk, and on the left we've got our annualized return, right? So you can see the risk starts to pick up and the return starts to pick up. But if we start at the bottom right as opposed to top left, you can see here that if you have a portfolio that includes 30% bonds and 70% stocks, you're essentially targeting a return around 8.5% odd, with the highest levels of volatility. So this is not efficient. It's not maximized, right? Because you can do a hell of a lot better. Soon as we start to,
sorry to butt in, Anthony, but I shared this yesterday, and I acknowledge I stole it from you. But the point being is that's where the majority of people money is. If you just take the standard portfolio, you've been put in a box, like that's what everyone else is. That's pretty much where I don't know what percentage is, but 90% plus of people are sitting.
Yeah, quite right. So as we kind of move from bottom right to top left, you can see each kind of pie chart includes more and more private equity. So it goes from 5 to 10 to 15 to 20, with the point being that you're actually, the more private equity or alternatives that you're adding to a portfolio, you're lowering your risk and you're increasing your annualized return, right? So this for us becomes a kind of efficient or a maximized portfolio when you're sitting with an allocation to alternatives of around 20%. We internally will go a little bit higher than that, depending on the client's specific interest and B, their experience within the alternative and private equity space. So a lot of entrepreneurs are very comfortable going to higher alternative weightings because they understand private business. They've typically run one or run and sold one, so they're comfortable in that space, in which case we would potentially push that to a max of around 30%. But for the better part of it, 20% is that kind of sweet spot. Obviously diversified by your primary allocation to equity markets, as well as an allocation to bond markets. Again, those two numbers, the 30 and the 50, are not set in stone. That's traditionally kind of juggled between the two based off fundamentals and the macroeconomics at the time. Like I said, bonds have not been the best place to hide for the last year or so, especially in long dated, longer duration bonds. So you would have been far better off in the stock market. But yeah, that's something that we weight accordingly. But I think the kind of key takeaway here is that allocation to alternatives and how it can diversify, decrease risk, as well as increase return. Moving to the next slide where I look at those, just two examples of active managers that have the two biggest indexes in the world as their benchmark. The first index being the Vanguard S&P 500. That's an ETF, but it essentially tracks the S&P 500 ETF. And we can see here that there's an active manager called Center American in our example. He's achieved a return over 5 years, annualized of 13% relative to the S&P 500's return of 11. Interestingly enough, his standard deviation is lower than that of the S&P 500, meaning that he has generated a higher return at lower levels of risk. And that leads to the positive alpha number, which I spoke about earlier, being a measure of outperformance, as well as a relative return of essentially 21.82%, which is an important number because it shows it looks like on paper, it looks like a 2% annualized outperformance, but on a cumulative basis, that number starts to get a hell of a lot more attractive at 21.82 relative to an already well-performing benchmark or index. So again, just an example of how one can find guys that can do even better than their respective benchmark or index. And then just another.
Anthony,
Yeah.
just one. Someone asked about SD, standard deviation. In simple terms, my understanding, if you look at return equals, the return you're going to make on your investment, and standard deviation equals risk. So what that means is, like in Bitcoin, you might have awesome returns, but you've also got massive standard deviation. So there's huge risk. So what you ideally want is you want high return with low standard deviation. Like that's what you're looking for.
That is the holy grail. Someone who can outperform on the return or the performance side of things, but do so at a lower level of risk. So just remember, the thing about risk is it's always relative to something. So in this case, we make it relative to the S&P 500, which is obviously quite a widely used, well-known benchmark. So assuming one would be comfortable investing in the S&P 500, one would be comfortable investing in an active manager that tracks the S&P 500, but does so at a better return and a lower risk. So those are the points there. And yeah, Scott, you're quite right. Standard deviation is the kind of key measure of risk numerically. All right. And then just on the bottom, again, another example, except in this case, we use the MSCI World as our benchmark, which I mentioned earlier, but that again is an exchange traded fund that tracks all the countries or all the shares in the world in the developed markets. And again, same scenario here. You see that the Schroders manager is able to generate a much higher return at a lower standard deviation or risk, leading to positive alpha numbers and a quite a large relative return of 42%. Again, on an already performing benchmark. So this MSCI World and S&P 500, I mean, this annualized 8.5 or an annualized 11% over 5 years is nothing to laugh about. Those are some seriously attractive returns. Alrighty, moving on to our next point. And again, this is a bit of a reiteration of what I've said, but this looks at one's personal outcomes and goals. Again, here I list short-term goals, long-term goals, or any defined outcomes other than retirement. And the point here is that those goals or requirements for the capital are going to be a very big driver of how the portfolio is constructed. I used the example earlier of buying a house versus saving for retirement. It's two completely different risk profiles because the timing is different. So we don't want to do anything. One doesn't want to go in anything overly risky if you know your time horizon is short, right? If you're saving for short-term goals. If you've got long-term goals that are typically longer than a market cycle of 5 to 7 years, then you're able to increase that risk profile a bit and target higher levels of return because you're not going to need to draw down on that capital anytime soon. So it decreases your risk of having to draw on capital during periods of volatility or market movements that are negative. So you're avoiding a scenario where you draw negative capital balances and you capitalize on losses on that capital if they are there. So that's an important factor just to keep in mind. Rather use low risk alternatives if you are saving for short-term goals, and then you can increase the risk profile as that goal gets longer or further away. And again, if you're saving for retirement and you've got more than 7 years, you can afford to add quite a bit of risk onto that portfolio when you constructed it. Our last topic, or our last slide, this just looks at the monitoring, measuring, and rebalancing of the portfolio over time. Fairly straightforward, but it's important to monitor your portfolio's performance relative to benchmarks on a quarterly and annual basis, just to make sure that everything's doing what it's meant to be doing. I would, if it's not on a quarterly basis, don't be scared to kind of push that to an annual basis. These portfolios obviously have different factors, and they behave differently in different market environments, but you're typically looking for that overall kind of trend over a couple of years. One needs to monitor the performance relative to the financial plan and the asset liability modeling. Again, this can be done at longer intervals due to market cycles, but important just to make sure that there is some kind of following of that roadmap. The reason why I say at longer intervals, because again, let's use 2022 as an example. Had you started your kind of planning or your journey at the beginning of 2022 and you went straight into a very poor year for returns in the listed market space, that typically works itself out over time, over an investment cycle of 5 to 7 years. So don't be too eager to change and mix things up just because 1 year you've been a little bit off the pace. As we all know, equity markets do not go up in a straight line. So you'll have negative years, you'll have positive years, but ultimately what you're looking for is that smooth kind of average over the longer term time frames. If you need to, over those longer term time frames, one will identify the changes in the ALM parameters and remodel this. So if things change, if capital value changes, if there's big changes to inflation or anything like that, you'll need to remodel this and just make sure that you kind of on track and everything is accurate. Otherwise you're going to get inaccurate numbers. And lastly, rebalance the portfolio if there have been any significant changes in the parameters, or if specific targets have been met. Reallocate to investments that offer greater upside potential. Again, fairly straightforward. If you've been in an asset class that's done exceptionally well, or an investment that's absolutely shot the lights out, don't be afraid to take profits and reallocate to investments that you believe are offering better value, that you can hopefully enjoy the same kind of upside from. You don't need to sit in something forever just because you feel that you don't want to make any changes. So don't be scared to rebalance the portfolio. Look for opportunity, spot the opportunity, and rebalance when need be. And that's it from me, Scott.
Awesome. Sorry, I couldn't find the unmute button there. I was like trying to find my mouse. Anthony, thanks so much. Do me a favor, just quickly before we wind up. Tell us just a little bit about Callio and how you work with the families. A lot of people come to me and they say, hey, I'd love to be able to try and, have someone that actually could help me do this, but not just put me in a box. And, there's that lovely testimonial that I've shared with everyone, and I highly recommend you go watch it, where, Cynthia came along. She was in Italy. So just to be clear, Anthony's mentioned South Africa. You don't have to be in South Africa. She was from American, worked out of Hong Kong, lives in Italy, and Callio has been helping her. And, one of the things that she loved was just the peace of mind. She met with you guys, you gave her the advice she'd been looking for. She'd had, I'm kind of putting words in her mouth here, but analysis paralysis for a whole long time. She hasn't known what to do. And you guys just sort of said, right. And you use fancy words like, I even need to look at it, ALM, asset liability monitoring. For us simple people, that's a plan. It's a plan to get from A to B. Okay, and what I think is so important here is that, yes, you guys have done it and are doing it for 60 of the wealthiest families, but you're also doing it for all the people that are part of the mastermind. And I think it's just giving people so much peace of mind to be able to go along and actually have someone that cares about them in a bespoke way, not just sticking them in a box. But tell us a little bit, just literally 30 seconds, a minute to, what is Callio and why do you guys, how do you do that? What's different from the high street solutions,
Yeah, so I mean, first and foremost, Callio is a global multi-family office, and kind of in the words there, global. Talking to your point there, Scott, that we're able to kind of service clients in multiple jurisdictions, including
stop sharing, dude, so we can actually see you better.
Thanks. Sorry. So yeah, we're able to service clients globally, which is obviously a key benefit. I think another important factor is that everything that we've run through today in terms of asset allocation and asset classes and things like that, we're able to offer in-house. So we've got in-house stockbrokers, we've got private equity teams, we've got venture capital, we've got the family office, we've got the wealth planning divisions. So everything you saw today can be done in-house. Nothing is outsourced. So that makes the process quite efficient, which is always something that you want. And I mean, in terms of the planning and the actual stages to it, take my presentation today as the kind of roadmap. It's about understanding the client, where they are, where they want to be, what retirement looks like for them, and how do we plan around that? How do we make sure that when we get there, we've done everything right, we've generated returns that are going to be able to sustain the client into retirement, and ultimately allow them to live a life that they want, as opposed to a life that they have to.
Yeah. No, look, I think that's brilliant. And I like what you said there with the 6 points as the roadmap. And just to remind everyone, 6 points, get clear on your time horizon. What is your risk tolerance? How do you do asset allocation? How do you diversify? What are your personal outcomes? And then monitoring, measuring, and rebalancing, so just to remind people that, sometimes these things, you hear standard deviation and you hear alpha, and literally people's brains just go, I have no idea what he's talking about. I'm scared. I'm not going to do anything. And actually, it's not that. Like, those 6 words make perfect sense. How long do you need time? How much risk are you prepared to take? What different assets are you going to put your money into? How are you going to diversify? Because you can't have all your eggs in one basket. What are the personal outcomes you want? I don't know. You want your kids to go to university, or you want to immigrate to a different country. And then finally, obviously, like anything in life, if you're flying an airplane from Sydney to London, the pilot keeps rebalancing like the direction, because you keep going off track and you have to keep going back so that you end up in London and not Moscow. So, that's all Anthony's actually saying. I want to be clear, to put it in simple English. But what I really appreciate, Anthony, is that you're keeping it simple for people, but the context and the substance actually is there, which is really important. And we've actually got Neil's coming to join us just to talk about it, what it feels like for him from the other side of the fence, to go through that journey. But just before we finish with you, Anthony, my last question to you And I know a lot of people are going to ask, and I know you very kindly said you'll come back and join us in the VIP room, for the VIPs to ask questions. There were some questions about bonds and other things. But in simple terms, high level, 1 minute, 2 minutes, what are you telling wealthy people at the moment that they should be looking at, thinking about over the next, 6 months, 12 months, etc.? And again, not financial advice, just roughly, where do you see the world going,
Yeah, look, Scott, I think there's always two scenarios to that. It's does the person have cash? What does their investment exposure look like? Their existing exposure. So if someone's got cash, I would suggest getting a bit of exposure to markets. I would look for a diversified exposure across different styles and sectors. I wouldn't be taking overly bullish bets on any one specific style at the moment. As we kind of touched on last week in the market commentary for the month, there are certainly some risks around. I think everyone is probably familiar with the war in the Middle East. Russia and Ukraine are still at war, so there are definitely some risks. But I think we're in a scenario now where markets can potentially surprise to the upside based off the earnings that are coming out of the US at the moment. So make sure you have some exposure. Don't put all your eggs in one basket. Always a good idea to have some kind of alternative or private equity asset class there, just as again, it's not correlated to markets, so it typically does the opposite thing during times of market stress. So you can still deliver some good returns. And again, it's very client specific. If you're targeting income or things like that, make sure you have some good income options that are paying steady interests, things like that. They all help in the bigger scheme of things. But yeah, to summarize, get some exposure if you don't have any. If you do have a lot of exposure, make sure that exposure is in the right asset classes and there's no overly bullish bets in any one direction.
Awesome. Well, dude, as always, absolutely incredible. I thank you. If Shane and you can just coordinate on the VIP room, we'll be a little while, but once we're there, we'll just coordinate. Deeply appreciate your time. And I think what I'd love to do now, and firstly, by the way, I don't know if you've seen all the comments, Anthony, in the group. Everyone's saying thank you. They're loving it. So appreciate the hands up because I really appreciate this. And I think I just wanted to share with people, just as you're leaving here, something that we do every month, and it's probably one of the greatest gifts that I've been given in 2023, was the partnership with Callio. Caroline, I think, asked the question, what's the minimum capital to be involved with Callio? And in our partnership, we've actually formed this mastermind, and we've partnered together, and everyone that's part of the mastermind gets access to Callio. And one of the things that's wonderful is that Anthony actually comes every month and gives us this market and sort of currency analysis and what's happening. And I always joke with people, I don't have the time, and to be honest, I don't even want to do it. I don't want to go and spend, a month researching what's happening with Israel and why did Silicon Bank go bankrupt, and, are inflation rates going up, and should I be doing something? But what Anthony does every month, and I love it, it's like a TED talk. It literally, like, what do I need to know? What's the impact of Israel? What do I need to do in the market? And, so as masterminders, we get the TED talk, we can ask questions. It's such an awesome recap. He also runs through portfolio construction in terms of the different assets and what they're doing every month. Now, again, none of us are intending to be financial experts in everything. But what we are intending is to start understanding the language, of how this actually works. And then we go deeper every month and we go into one asset class. So whether he's talking about private equity or alternative investments or, structured notes or whatever, you actually know what they are. And then, the whole idea is to invest. But without further ado, I wanted to say thank you to Anthony. You've given everyone a snapshot of kind of what we do on a monthly basis, actually, in terms of the fundamentals. And you've also given people a snapshot of what you do when we do step 2, which is where people analyze the portfolio. What do they have? What is the starting point of what you've got, and how do you optimize your portfolio? And that is really why I wanted to pivot to Niels, because Niels has only been in this journey for a month, 2 months maybe, Niels, I think, in terms of the process. And Anthony, I just want to thank you for your time, dude. You're very welcome to stay on if you want. But what I wanted to do was to give people a feeling from what it's like from the other side of the fence for Niels, because as he said in this little WhatsApp that he sent to me, it can be overwhelming. All this language is overwhelming. How do you learn it? Niels, what I wanted to do is stop sharing here and just pivot to yourself and say, tell us a little bit about your journey in that process, because this is an overwhelming space. You know, you arrive, people talk a funny lingo. No one like you're almost too embarrassed to ask the question because you don't know what to ask. What's it been like for you, going through that, experience, and also, you and your wife have been trying to invest and you've done a lot of stuff, but what's it been like sort of starting to clarify and understand this language of investment,
Hey, good morning. Morning, Scott, Anthony, Shane. Yes, sorry for being late. I had urgent meeting this morning.
You
But
like,
I'm here.
We're all good. We're all good. You're on time, and we can hear you. Michael joined us on Monday, and we couldn't hear him, so it's all good.
Yeah, yes. Look, our journey with you is like 3 or 4 months. I mean, I think I must give some background here just to explain why we joined the mastermind group in the first place. I mean, it goes back. There's basically 2 reasons. We joined the group over the last, I would say, past 9 years. We basically started investing or doing international investments. Now, when we started off, we saw a lot of specialists, trust specialists, international financial experts, and lawyers and all kinds, because we wanted to set up a structure that we can basically use going forward with all our investments. But the end result, for several reasons, is that they basically all said that, no, you don't have enough to invest, your portfolio is too small, and you should rather invest in your own names, which we did. But this comes to a problem because, by 2022, we basically had 3 financial advisors. We had PSG, we had Brenthurst, we had Anchor, we had property in the USA through a company there, lots of tax issues. We had investments going on in the UK. And we basically realized that it's actually all over the show. It's chaotic. So we were looking for a solution and someone to help us with this. And that is when we joined 1 or 2 of your webinars. But if you remember correctly, we basically joined 2 webinars and then I joined the mastermind group, because at that stage, I already knew what I want. And we really needed more info and knowledge about the asset classes and alternative investments. And I think it was August or September when we got introduced to Calio Capital. And so in general, I would say our experience with Calio was very, very positive. And I'll explain to you why. With the other advisors we had in the past, is they were all nice people and they know what they're doing in their small field, but they are normally one of hundreds of advisors in a company, but they are not the decision makers. And typically what you get is you don't ever get a holistic view. You never get advice on taxes. You never get advice on where to go, how to do this. Nobody takes your hand and help you. They'll just refer you to someone in the company with some knowledge about something, but they don't know where you're going. And it became really frustrating. And that brings me back to Calio. I always, when I went to the Calio meeting, it was an in-person meeting with Garth and Anthony. We always had in our back of our minds the thing that, yes, okay, this is just going to be the typical financial advisor. We hope it wasn't like that, but that's what you expect. You're going to go through the things, you're going to end up paying commission, and you're probably never going to get advice, and they're never going to take your hand and help you. And we really needed help and advice. And there's 4 things that really stood out for me. The first thing was, on our first meeting, Garth and Anthony was there in person. It was in Johannesburg. And that was something new for us. I mean, we've never had this. We know they are very, very busy. And we know they are some of the decision makers in Calio. But this is something that stuck with us, because it's very difficult to work with employees that only know something about this small field. I mean, you have 2 people that got loads of experience, international experience. They connected, they understand what's happening in the US, they understand what's happening in the UK, tax implications. So we were quite impressed. So then Anthony took us through the, basically through all our portfolios. He made a summary of all our assets, all our investment in shares, ETFs, unit trust funds. And although we really knew this, we saw it ourselves, but the picture that he put on the table, I mean, the summary basically confirmed what we always knew. And that was that a big percentage, I can't remember, 45% of all our investments was basically overlapping. We were not really diversified. We knew this, but it was actually worse than we thought. And to see it on paper was really a fantastic thing. And funny enough, as I always say, as I told my wife the other night, is that we did the same with the previous advisors. We gave them all our data. We gave them our share portfolios. We gave them info into our assets in the US and the UK. They never made a summary like this. They never even considered it, because in the end, they invested in exactly the same things. Overlapping shares, overlapping ETFs. And that was our frustration all the time. And Anthony gave us a very good summary. It took a lot of work, I'm sure of that, and that we really appreciated. So then they basically presented us with a proposal of how we should structure these things, what we can do, how can we remove all this duplication. And they even gave us advice on our property in the USA, which we really appreciate. For the first time, someone basically comes up with a plan and put their names behind it, because the other advisors normally just do whatever their company tells them or what is best practice at that stage. So we found that very positive.
Also, Niels, there's also, sorry to butt in, but there's also very few people that can talk cross-border. So like they're very good at talking about their box, but suddenly you see property in Texas and it's like, oh no, sorry, we don't do that. Like, you know what I mean? Like,
no, exactly. That's a huge problem. I mean, there's implications in everything. And it's easy to tell people to, go to speak to this specialist or that specialist. But in the end of the day, we ended up taking all the decisions. They never took any decisions, and they really didn't guide us. So this was different for us. Someone is trying to tell you what to do and why, and take responsibility with you. I found that very positive. And then, Anthony and especially Garth discussed the tax implications of these moves. What's going to happen when you move these portfolios, when you sell your shares and you move it to them? How can they help us to do this to avoid unnecessary taxes? They even gave us some advice on our US property and how we should go forward. So all four of these things basically for me was new. I've never experienced this. Now, because we knew why we came onto Mastermind and what we wanted, it was an easy decision for us, and we decided to go with Galileo. And we are basically now, within the last week or two, we've almost transferred most of the portfolio. The last few documents was handed in last week. We're almost ready for the share trading. So yes, I think in the next 3 or 4 weeks, everything will be in place. We're also busy with our property in the US and in England. It's a bit longer process, but we know exactly where we want to be and where we're going. Of course, in the end of the day, the proof is in the pudding. I can only tell you in 6 months or a year or so if it was worth it. But this is the first time we feel that someone can actually look at our things holistically, summarize it for us, come up with a positive plan and back it with their own names, and then take your hand and help you to do this. Nobody's perfect. There's always administration issues and things that has to happen, and this take a bit longer and that goes. But I would say the overall process of Galileo was exceptional.
Awesome.
Much better than we had.
No, that's fantastic, and I appreciate you giving the feedback. And I fully acknowledge what you're saying, Niels. The proof's in the pudding and everything else. But one of the things that I wanted to share was more your human experience you've been through, not the financial experience, the human experience of, again, we all kind of lost in the woods and not knowing what to do. And everyone we go talk to, particularly if we're wanting to go international, there's no one that has a holistic overview. They all try and stick you in these boxes, no matter what the boxes are. And so what I've always appreciated when I hear your story and other people's stories, no, it's a holistic experience. And it kind of, it speaks more to the human part, which is the peace of mind and the, okay, hang on, got someone here who can kind of hold my hand and come up with it, So I just wanted to kind of talk to that. And you wouldn't have heard because you weren't on earlier, but, Derek, who was a farmer, literally used the word phenomenal 2 weeks ago. It was the same thing. Like for decades, he'd been trying to look for someone to hold his hand. And now he finally has it. And, for me, it's not, Calio is not for everyone. I get that. And we're not trying to, this is not a Calio classified, like in the thing, but for the right type of people. And again, that's why part of the mastermind, for the right type of people that know what they want and they can really be a solution. And that's one of the reasons for me, I always talk about information and partners. And I think my job is to go out and find the right partners. I don't, if you talk to me about tax and structuring and pension funds, like I've got no idea, literally no idea. But what we are good at is going and finding the right partners to help people with, in that process. And that's one of the reasons why I so appreciate the partnership we've got with Calio, But yeah, just that human experience, I just want to, highlight what you've spoken about. The financial returns, hopefully for you and the family will come. But it's the human part that you've been through. Now it's the financial part in terms of the execution,
No, definitely, Scott. I mean, it is so stressful not to know where to go. To have financial partners and advice. I mean, just the connections that you gave us with Calio and others, bring us in contact with these people to understand it. It makes a world of a difference. It takes a lot of stress off your shoulders, weight. It's actually a very positive experience, especially in the world now with all these uncertainties. But from a human side, I mean, this was a phenomenal experience. And it happened so fast for us. But we were ready for it. I mean, because we've been sitting on this for 1.5 years, just frustrated, don't know what to do. But I believe, going forward, it's going to work out. Whatever is going to happen on the financial side, I feel that we have proper partners in you and in the mastermind and with Calio. It's a very positive experience. It's a positive, relaxing feel. We've been through a very difficult three months now with all the administration to do these things, to move it, to shift properties. But it's almost done, and we can see the end. So, yeah, I think it's worth it. Definitely worth it.
My last question to you, and I know you joined Wealth Going Global originally, and you made me this comment here, something along the lines of listening to all the Zoom meetings has made a huge difference understanding the investment options. I don't feel stupid anymore when having discussions with the likes. Of course, I don't know enough, but at least I can follow opinions, comments without being completely in the dark. It's so liberating. Just talk to us a little bit about that evolution. I don't know what you want to call it, but it's like learning investment language, it's like learning Mandarin, like whatever, and almost having the peace of mind to talk about it now. What's that been like in terms of, because you've obviously been, and again, to be clear to you and for everyone else, this doesn't happen by random. Niels and his wife have invested their time and their energy to come and do Wealth Going Global and to learn the lingo and to be part of the mastermind. Like it's not like a little, a microchip that you just stick in your head, but you've been prepared to put in the effort. And what's it been like learning that language? Like,
no, just Scott, to be honest with you, I mean, we thought we knew some things about investments and financials, but obviously in a specific asset class or two. But you tend to, if you don't understand something, you tend to avoid it. And we knew that we basically knew 5% of what we should, just on a basic level. And just to learn the terminology or understand it when someone speaks on a webinar or something and they say something, you immediately know what it is. It makes it so easy to engage and learn more. It's not a struggle anymore, because we found it as a struggle. You read these things, you immediately lose interest. You don't understand it. You don't know what it's about. You don't know the risks. It's just too much, you know. And we found that it was made quite. You presented it on a very basic level initially, and then you got your discussions on a specific asset class. You know, it's still on a basic level, but it made sense for us. And it's actually very nice now to go and listen to any webinar, and all these words pop up, and you just know what it is. It falls in place, and it literally took us 2 months to understand the basics. I would still say we are very, very, very beginners in this terms, but it's not our field. We are not financial advisors. We don't work in the financial world, and we have to rely on other people to do it and to advise us. But just to understand what they're talking about has made things incredibly more clear over the last 2 months. It's actually a wonderful experience. I'm glad I basically skipped all the Wealth Going Global seminars in the beginning and just moved straight to the masterclass. I could do it because I had some experience. That is also true. But I still follow the Wealth Going Global as well, you know, so I'm still in both and still learning. And but my opinion is it's worth it. Awesome. As soon as you can, get as much of yes, and even when you do the seminars, we sometimes don't understand it, you know, in the mastermind, and then I just go through it again and I sort it out, and that helps so much, you know. But after repeating it 4, 5, or 6 times and bring up the terminology, it sticks, and then it becomes clear. It becomes easier. It's basically repetition of a lot of things. So yes, very positive.
Awesome. Well, Niels, thanks so much for your time. I really, really appreciate it. You know, for me, I always think there's real value in real people, real stories. And, you know, a lot of people hear Anthony talk. I've sort of already mentioned this, and they literally go into overwhelm. And we've all been there, literally every single one of us. So I just wanted to kind of share your experience, and I really deeply appreciate your time. Thank you so much. And thanks to you and Catherine, and I look forward to seeing your results, you know.
Thank you, Scott. And just one comment. You will feel overwhelmed. Most people do. It's nothing wrong with that. It's just be open to ask, you know, and just do the repetition. Just follow the course. Go watch the video clips. It will stick somewhere, and it will start making sense.
Awesome. Well, thanks so much, Niels.
Thanks.
Appreciate it. Cool, guys. So I'm going to pivot now quickly. And before we join the VIP room, a number of people have asked me, and there's a lot of questions that have been coming up, sort of what is the mastermind? And so I've already shared it with the people in the VIP room, but I just wanted to share it quickly with the rest of you, basically, in terms of it here. And where am I going quickly? So just 2 seconds. Okay, so what I basically wanted to share with you was just what the mastermind was about. So reminding you again, let me just, where's my slide going? Reminding you, this is the goal: globally diversified passive income, diversifying across countries, currencies, assets, partners, and time. And in simple terms, we've got 2 choices in life. We can go and do it all our own. We can do the home study and everything ourselves. Okay, you might have learned now that that's probably the stressor mode, or you can do it in partnership. And that's what the mastermind's been created for, partnership. So just in terms of some psychology, if I give you a plan, you're not going to be committed to it. If I give it to you, Kelly gives it to you, whatever. But if you come up with a plan yourself, you're going to be 5 times more committed. And for me, you know, one of the things is that everyone wants results. Me, I'm passionate about helping people get results. But actually all the stuff below the iceberg is what's important. Emotions, habits, values, thinking, assumptions, bias, world, defenses, essence, etc., your values. And so where we find ourselves in the world at the moment is a lot of people are in an away state, no matter whether you live in England or, you know, Australia or America or South Africa, it doesn't matter, because the world is in a funny place. So you find yourself in a away state, withdrawn, fearful, inability to make good choices, demotivated. And what you need to be is in a toward state. In fact, actually, when the markets have challenges, like Anthony just said, there's actually opportunity. And so it's about being in a happy state, ability to think clearly, creative, see new opportunities. And there's 2 ways to do that. The first is to be in a like-minded community. So be with a like-minded group of people that are all pulling in the same direction. And the second is that 95% of people get caught up in their problems and their drama, and it's about getting very clear on the outcome. What do you want? Don't worry about your problems and drama. Don't worry even about brainstorming action. Get very clear on your outcome. And we call it the lighthouse approach. And I want to share with you, I've been part of Mastermind since 2011. Whenever I've joined a mastermind, I've done it to phenomenally and measurably move forward. And I found this video which explained it to me. I didn't understand why, because I've been part of them since 2011. So whatever that is, 12, 13 years. But whenever I was part of a mastermind, I made measurable progress a lot faster. And I found this video and it explained to me why.
No, this is extremely predictable. Tons of research around it. Humans change 5 times faster in groups than they do with a one-on-one coach, consultant, or therapist in that case.
Wow.
So I started looking back at business models and people who had done this effectively over the generations. Masterminds aren't new, folks. They're not new at all. People have been doing this for thousands of years. And when you put a collection of people together who are all committed, all driven, and all so want to make the right changes happen, and you give them a leader to follow who's willing to get in the trenches with them, all of a sudden you start finding real, rapid life or business transformation.
So, you know what he said there, when someone's in a group 5 times faster than doing it one-to-one consultant or therapist, and when you have a collection of people who are committed, all driven, and so want to make the right changes happen, and you give them a leader to follow who are willing to get in the trenches with them, all of a sudden you start finding real, rapid life and business transformation. And that's why we created the Mastermind. You know, 10, 12 years ago, we used to go on buyers trips, and I would fly to America and sort of 10 people would come with me and we'd go buy houses and we'd go buy commercial buildings. We'd have an incredible 2 weeks together. We get to know each other. We'd build trust together. We'd meet the partners on the ground. We'd kick the buildings. And this is really an evolution of that, because now it's the same concept of the buyers trip. We have those same personal relationships, but we do it, you know, not just in one location. It's about fulfilling this and building globally diversified passive income, and ultimately about diversifying across countries, currencies, assets, partners, and time. And there's literally 5 steps to the process. So, you know, you've got the outcome, and that's where I sit with you one-to-one and I get very clear on what you want. Then we go to the starting point, and it's like, where are you starting? What property do you have? What portfolio do you have? And that's where we partner with Calio to get very, very clear on your starting point. So now we know where you want to get to, and we know where you're starting. Then it's about building a plan to get from A to B. That's what we call the wealth plan. And then most people don't even have a plan in life, a clear plan. But when they do have a plan, you've actually got to execute on the plan. So for a year, we go on a journey together once a month. And if you're time poor, we've specifically done this to be very effective with time. So it's 3 to 4 hours a month. It's about condensing time. You know, if you're running a business, you're very time poor, whatever it is, it's been created 3 or 4 hours a month, invested in yourself to create your reality over the next 5 or 10 years. And I always say to people, if you don't have 3 or 4 hours a month, then it's never going to happen. And so what do? We do 2 things. One is that we operate at the accountability, the mindset, and the execution. So it's about holding you to account and making measurable progress every month and hitting the milestones. And then it's about the investment, which I've kind of alluded to already today, which we do with Calio on a monthly basis. We review the markets, we go deep in an asset class, and we actually invest. So let's just look at that in a little bit more detail. You know, I'm an internationally qualified coach. And so I take people through the process. I get very clear on your top 3 outcomes, your top 3 measures, and we write them down. And it's literally fulfilling the lighthouse approach and getting very clear on the outcome. And one of the gentlemen that joined is from Germany. He's been a life coach for 27 years. And he said to me, love the process. You know, it's incredible how few people take 90 minutes of their life to get very clear on what they want. The second part is the starting point. You know, we get clear on your property portfolio. One of the guys in the mastermind was in England. He had a bunch of properties in England. Some of them were cash flow positive. Some of them were cash flow negative. We literally helped him look at this portfolio and look at, you know, and we did a swing where his properties were costing him £750 a month. And by doing a few things, he could get rid of the bad properties. He could increase his cash flow by £2,000 a month. He could start investing in America, and he could earn a far better return in terms of it. Then in terms of a family office, you know, family offices have traditionally only been for the wealthiest people, but with our partnership with Calio, they've actually become available to anyone that's part of the mastermind. And the reason being is that we align, you know, so what Garth Wellman, the co-founder, said is that the 1% can pay for advice and get results, we need to support everyone else to get the same advice and results. And as Neil said, literally, I think it's better for now to get one advisor for all asset class. We had so much duplication between the different advisor investments. We just want to simplify our admin, our tax, and our structures, and it'll take a while to complete. It's just that peace of mind to have it all done in one place. Then, imagine having a plan, whether you call it an ALM or whether you call it a wealth plan. In simple terms, it's about getting you from A to B in that process. But then it's all about execution. At the end of the day, it's the execution that's going to get the results. So it's about staying in it towards state. There's a whole bunch of modules we've got around time management, mental wealth, flow, etc. But the most important thing is the accountability tracker. Literally holding people to account on a monthly basis, whether it's the carrot or the stick, but ultimately making measurable progress every single month in terms of getting the results that you want. And the research is overwhelming in terms of having an accountability partner to be able to get results in that process. And then finally, it comes down to the financial part. And we run a rhythm here every month. Anthony, who you met today, comes and does us the analysis like I've explained. He does the portfolio construction in terms of where you're looking at. He basically, then we bring one of the partners every month and we go deep into different asset classes, whether it's multifamily, structured notes, gold, industrial buildings, medical buildings, we've got private equity. Next month, we've got UK fixed debt products, et cetera, et cetera, et cetera. And I mean, the feedback we've just had from people has been overwhelming in terms of, the learning and everything in between in terms of where we're at. So that's it. I always say that there's simplicity in power, 5 simple steps. And once you've gone through the 12-month journey, in simple terms, you go back to step 1. Every one of us should be once a year just reviewing our portfolio and effectively going through it. So taking a very complex process, holding your hand in the process, 5 simple steps, repetition's the mother of skill, and getting results in it. Now, according to Harvard, if you try and do it on your own 3 months from now, you're going to remember less than 10%. But, according to Harvard, if you do it in a non-directive way where people are holding your hand, you've got a 95% chance of success. And as Cynthia said, thank God for the mastermind, the partners it brings us, and the exponential learning curve you've gifted us. And, I've shared with you her testimonial. I'd highly recommend that you go and listen to her story of how she started to generate passive income in under 2 months. And it just gave her that peace of mind, as a single mom, etc. So what do you get? Access to myself and the team. You get access to the tax and currency partners. You get access to all the modules of asset mastery, whether it's structured notes, multifamily, medical, industrial, co-living, the wealth reports, gold and silver. You also get access to Wealth Going Global. I'm going to talk about that more tomorrow, but it's the home study course. So you get that for free. You get Clem Santa and the full understanding of all the scenarios, both globally and locally, in terms of what you're looking at. You get our Wealth Hacker subscription, which is, again, a whole bunch of content in terms of substance. Someone asked me yesterday about immigration. You get access to our partners that we believe, having done this for 20 years, are the best to actually help you in terms of immigration, if you're looking for immigration. And then finally, something I want to start next year again is buyers trips, where we tangibly get on an airplane, fly over there, go and meet some partners on the ground and create an experiential experience in terms of where we're at, like we used to do 10 years ago. So if you are interested, it's by invitation only. So all you got to do is go to diversificationchallenge.com and fill in the questionnaire. And the reason being is that if you remember back to that formula, he said you've got to have a bunch of committed people, like-minded people, and that's how you get the results. So I meet with everyone one-to-one. Myself and my partner, Alex, work with people one-to-one, and we need to make sure that the right people, are part of the mastermind. We need to be aligned in terms of what are you trying to achieve. We need to make sure we can help you achieve that. And that's why we just meet one-to-one. It's not for everybody, and that's why it's invitation only. So there's no downside in going in and applying. And even if you don't qualify, it doesn't matter, because we can always have a conversation with you and help you in the right direction in terms of that process. In terms of a guaranteed satisfaction, I think you might have learned from me over the last 3 days, I don't take prisoners. And, for me, I'm going to do whatever it takes, carrot or stick, bringing in the different partners to try and help you get those results. And, for those of you financially minded and say, well, what about the ROI? And, this gentleman had $12,000 to invest, and he was getting about a 7% return in his current financial product. And I said, well, if you can get a 14 or 15% return, which by the way, Kelly and I have shown you all day is possible, you know, and you were to prepare to invest $5,000 in yourself to make this a reality, to get access to the right partners and the right opportunities, your return on investment over 5 years would be 250%. In simple terms, you would put $5,000 in and you would get $12,000 back in today's money. Now, again, that some people will go, that sounds too good to be true. It's not. It's if you've got the right information and the right partners, it makes a material difference over a 5-year period. If you do a 10-year period, it's 10 times. If you do a 30-year period, the numbers get silly, but that's the power of time. And most of you should be thinking about generational wealth and what you're doing, not just for yourself, but for your children. So, you know, 10 years ago, you had to say yes, like Michael, who you met on Monday, and you had to come on an airplane. In fact, this is a picture of Michael and us in New York in 2013. Sorry, that's not Michael, that's Michael. But if you want to do the digital experience now, which in my opinion is even better, because you can get access to Calio and the different partners from around the world, from the comfort of your office or your couch, you literally go to diversificationchallenge.com/apply. And, you know, I'm sure it's in the chat box already, and you can apply. And if you look here, just to show you some pictures, this was us in New York. This was us with Dolph DeRuis buying auction property. I think I showed you this on Monday. You know, I paid $8,000 to go with Dolph DeRuis for a week. But my philosophy was I could go to America, I could spend weeks, possibly even years trying to learn all this stuff, or I could pay him $8,000 to get the knowledge on the ground, get access to the right, you know, auctioneers, to buy the right properties. You know, he's the author of Real Estate Riches. And I was like, why not just go straight to source rather than try and learn it all myself? You know, we had lots of fun in terms of the process, but, you know, this was us buying houses, different houses. This was us buying multifamily in Florida, opening bank accounts. You know, in the old days, you had to fly over and open bank accounts. Now you can do it all online. You know, meeting the different partners on the ground and learning from the different partners. You know, that's what you're doing now digitally. So we've really recreated the buyer's trip with the mastermind. It's a small group of people. We're learning, we're having fun together, we're learning trust, and we're getting access to the partners and the information in terms of that process. So, you know, I think if it's something that that interests you, you know, I believe that, you know, one of the reasons why people should work with us is that the 3 major things that hold people back: I don't have the time. We've literally created the mastermind for time poor people. If you've got 3 to 4 hours a month to invest and you want to build globally diversified passive income of at least $5,000 plus, so $5,000 plus passive income, then, you know, 3 to 4 hours a month is nothing to make that a reality. I don't have the money. Well, you'll be surprised. You actually need a lot less. As I said, you know, literally $1,000 or a month for 12 months or $12,000, anything above that, and it makes perfect sense. And you'll be surprised how many people, it's just about optimizing their current portfolio, which Calio does, like they did for Cynthia, or just looking at your current properties, like I did with the guy in the UK, in terms of that process. And then finally, I don't have the knowledge. Well, that's why we created it. As Neil's just said, it's about getting access to that information. And lastly, it's all about global diversification. I'm the only one that's aware. You know, everyone else is going to try and stick you in a medical building in America, or a house in, you know, England, or a student accommodation in Manchester. It's the only one I'm aware where it's all about diversification, bringing in different partners. And just to put in perspective, I'm not telling you to do something I haven't done. You know, I was part of Singularity University for a year. That cost me $14,000. I was part of Roger Hamilton for, you know, which is an entrepreneur group. That cost me $25,000. I was part of Mavericks, which cost me $40,000 for the year. And that got me to spend, you know, a week on Necker Island with Richard Branson. And I also spent $50,000 to join, you know, Tony Robbins in Fiji. And, you know, people look at me and they go, Scott, you absolutely flipping crazy. And I go, no, not at all. Because if you put yourself in the room where you're the dumbest, poorest person, you can only go in one direction. And by the way, our mastermind is a hell of a lot more affordable, because we want people to have money to invest in deals and to be able to grow passive income. So that's our whole philosophy. But that's the formula, and you get to decide. Do you want literally someone, you know, do you want to do it all on your own? We'll tell you tomorrow and Friday, you know, how you can literally do it all on your own, or you can literally do it with me and with the Calio team, and we help you make that a reality. And that's what the mastermind is about. There's literally 5 simple steps, and you've literally got the bonuses, working with me and the team, working with the tax and currency partners, getting access to asset mastery, getting access to wealth going global, getting access to Clem Sunter, the wealth hackers, the immigration agents, and the buyer's trips. So if that appeals to you, my recommendation, go and apply. I need to jump to the VIP room, but this is a few more of the pictures. We've done lots and lots of these over the years, buying commercial property, buying houses, having some fun, meeting partners. You'll see it's over and over again. So it's just really the mastermind is a replication, a digital replication of what we did over the last 15 years in terms of buying property. This guy, Paul Shalanda, we're actually meeting his partner tomorrow, Bruce. Incredible guy. We've been doing deals with him since 2014 in America. This is one of the buildings we actually bought with him. Buyers trips in Hong Kong. So, been all over the world in terms of looking at this. So yeah, if this is something that appeals to you, then, that's how you apply for it. And I finish off for today with a good African proverb. If you want to go fast, go alone. If you want to go far, go together. There's the formula. You can do it alone or you can do it together. You get to choose. The mastermind has been created to do it together. And your action steps for today for silver. So the first one is, it's in the wrong. Let me just bring them all up then because it seems to have come up in the wrong direction. So research and identify at least 3 different investment strategies. So passive investing, active investing, and value investing. Create a hypothetical diversified investment portfolio with different asset classes and allocating different percentages. So I showed you that wheel like Fiona had us right up front. Consider the mastermind if it suits you, and you've got the application link if you want to go and apply. And then share your key takeaway using hashtag diversification. And for the gold, it's research different asset classes and their historical performance, and it's research and compare the different investment vehicles. So hopefully, that gives you some good direction now based on the fundamentals of what you've learned. I'm now going to go to the Q&A. I'm going to be answering, and Anthony's actually going to be joining us. I remind you of the 6 main themes: time horizon, risk tolerance, asset allocation, diversification, personal outcomes, and monitoring, measuring, and rebalancing. And if you are interested, you can still join us. You literally just go along to that link, VIP upgrade, and you'll not only get access to these VIP sessions for the rest of the week, but you'll get the recordings. As Neil said, it's the recordings that are powerful because you can go over it a couple of times. Repetition's the mother of skill, and you're going to get access to module 1 of Wealth Going Global. That's worth quite a lot of money already. So for $47, it's an absolute no-brainer. Reminding you that the WhatsApp group is how we're going to communicate. The Facebook group is how we're going to collaborate. That is the formula. Tomorrow, we're going to go into Wealth Going Global and literally the steps that you can take, because my expectation is that by February next year, you're hitting the ground running. If you've come this far, by February next year, we want you to be running at full speed. And we're going to share with you tomorrow how you can do that. If you run a business, if you're in corporate, you'll know that you don't go and start planning in January or February. You've done your planning this side of Christmas so that you hit the ground running. We've literally got a solution for you November, December, January, February, so that by the end of February next year, you are measurably far from where you are today. And we'll literally take you through it. And we're going to share with you how you get the right information and how you get the right partners. But ladies and gentlemen, that's all for today. Tomorrow, we've got some incredible people coming. I've got Judd from California coming to share with us how you manage risk. He's been in the industrial sector for over 20 years. I've got Bruce Saunders, that is a CA coming out of Atlanta, and he's been in the property market there now since 1997. He's going to be sharing with us how to manage risk, what are the different trends. And then very, very exciting, we've got a gentleman from Cambridge University with a PhD from Cambridge University coming to teach us about risk and in private equity. And we've got deals in both Germany and Manhattan at the moment. And he's going to be talking about those deals and how do you manage risk in terms of those processes. So I wouldn't miss tomorrow. And as always, I finish off with Nelson Mandela. Money won't create success. The freedom to make it will. The prize winner for the VIP is Linda Welsh. So Linda, thank you for all the participation today. It's been wonderful for your attitude. I look forward to seeing you in the VIP room. Shane, thank you for everything you're doing. And yeah, if you want to join us in the VIP, literally just go to the VIP upgrade. But it's now time for that VIP. I need to pivot. I'm going to go and answer any questions that I've got, anyone's got in terms of it. What Shane does is he takes all the questions out of the chat and the Q&A and he puts them into a PowerPoint. I turn up in the VIP with Anthony and we help you. So in conclusion, that's it all from today. Today was not about me. Today was about Fiona, Anthony, and Niels sharing the experience of what you can or can't do. But I leave you with one closing thought. And it's that African proverb. You can do it all on your own. And I did that for 14 years, the hard way, making lots of mistakes. Neil shared his own experience, or you can do it together in partnership. And I think you've probably learned after the 3 days that there's a hell of a lot easier way to do it. And so, you know, people that are prepared to commit to themselves, to commit to their future, that is what the mastermind is about. If it suits you, come and join us. Otherwise, we'll see you tomorrow. We've got a super, super exciting day tomorrow. And to the VIPs, I'll see you in the room in 2 minutes or so. Cheers, everyone.